Ladies and gentlemen, thank you for joining us for our webinar during your lunchtime. My name is Billy To. I'm the Regional Head of Retail Research at CGS International, and I will be your moderator for today's session. Now, today we're very lucky we have IREIT Global with us. So they will be talking about their results and key priorities ahead. For those of you who are not familiar with IREIT Global, it is a REIT that actually focuses on investment in Western Europe. I think primarily in office, retail, and also for some industrial purposes as well. Now, before I pass the time, I'm just going to do a quick introduction on our speaker today. His name is Mr. Louis de Estaing Diouf. He is the CEO of IREIT Global. He is the person responsible for the planning and implementation of IREIT investment strategy, the day-to-day management and operations. So if you are here for today's session, you're very lucky because you can actually ask him the questions directly. It's not every day you walk in and talk to a CEO about the company's management. So make sure that you stay until the end of the session where we will have our Q&A, and you can just put in your questions towards that. Just a brief introduction on his background. He's actually has over 17 years of experience based in Paris, France, and he has a lot of experience in European real estate investment. I think this is going to be very important, especially with the shift of the interest rate environment. So there might be some interest back into REITs. So you guys will probably want to see if IREIT Global fits into your portfolio, especially if you're looking into investing in REITs that have exposure in Western Europe. Now, without much further ado, I'm just going to pass the time to you, Louis. Yeah. To you.
Many thanks, Billy. Good afternoon, everyone, and thanks for joining the session. Very happy to be with you today and with the rest of the team. So let's start with the some elements we're sharing with you now about IREIT. So maybe just as a quick intro, IREIT, as Billy just mentioned, is a pure play Western Europe focused REIT. And what is a real specificity or unique positioning from IREIT is that we've got two joint sponsors. We've got TKO Capital, which is an alternative asset manager managing over 46 billion euros of assets across the globe. And you've got City Development Limited that we don't need to, I do not need to present to you. So a combined approach of these two people, and both of them in total own almost 50% of the REIT. So there's a strong alignment of interest, especially in this kind of period where there's a lot of turmoil. And I think it's a strong, element to take into account when you're a unit holder or an investor. The portfolio is comprised of 5 office properties in Germany, 44 retail properties in France, and 4 office properties in Spain. So now a total value of the portfolio is 855.6 million euros, with 61% of the value, which is in Germany, and office represent 76% of this total value. If we go on the next slide, we've got a sample just of the buildings across the region. So many, Germany and Spain offices, and then France purely retail, and an occupancy rate close to 90%, over 100% leases, and 53 properties. If we go on the next slide, on the key highlights for the first half 2024, we published our result earlier in August. So we had a significant increase year-on-year of our net property income, due mainly to the new acquisition of this B&M portfolio, which is a hard discount retailer performing extremely well. Also new letting on Darmstadt campus. And last but not least, we have this property in Berlin where the tenant paid us a significant amount before, vacating the property and repositioning the property at the end of this year. If we look at the weighted average lease expiry, it remains stable since third quarter 2023, thanks to new leases and lease extensions that have been signed, while we are benefiting from a very low aggregate leverage of 37.2%, putting us in a good position, being healthy compared to the rest of the sector. It has improved since December 2023 with the sale of one property in Spain, and it enabled us to be in a position to eventually tap the bond market later on. And last but not least, and still related to the debt, one of our strengths is also the low cost of debt at 1.9%, which is almost fully hedged at 97.1% of all banks' borrowings, which are hedged. If we go on the next slide, it's on the repositioning of Berlin campus that we mentioned earlier. So maintenance in Berlin decided to vacate the property at the end of this year. We've been working for significant period of time on the repositioning of the property, and this will enable us to reposition the property later on into a mixed-use asset. The tenant, as I was mentioning, will pay a lump sum amount which equals to 16 months of current rent. And we are currently in advanced stage to enter into 20-year lease agreement with 2 hospitality operators. And we've got also advanced discussion with other office tenants. So the project is moving forward pretty well. And will enable to unlock the value that we have on this property, because there is a significant under rent so far that we could benefit from, as the location has significantly improved over the last 10 years. If we go on the next slide, which is more on the financial performances, if we look at H1 2024, the income to be distributed to unit holders has increased by 3.9%, and it's mainly related to this new or full contribution of this B&M portfolio, retail portfolio in France, and also the end of the rent-free period that we had in 2023, and which was related to some new leases or new extension that we negotiated in 2023. So income and dividend that has increased compared to last first half. Let's go to the next slide. As you can see, that's what I was just mentioning, and then you had the payments of the dividend that occurred at the end of August. If we go now to next slide, it's more on the financial position and on the NAV. NAV has moved slightly, has dropped slightly by 3.3% compared to December 2023. And that's mainly related to the decrease in valuation of the investment properties. But as you can see, it's a minor drop. So what we can consider is that the NAV remain, pretty stable. And also one portion of this drop was related to a weaker currency exchange rate. So that's also a reason. So if we look at, now the NAV and we compare it to the unit price, and here it's as of, end of June, the trading, IREIT is trading at a discount of almost 52%, which is, pretty attractive. If we go on the next slide, on the debt side, as I was, mentioning just at the beginning, we have a healthy position with an aggregate leverage which has reduced compared to December 2023 at a level of 37.2, which is lower than the overall IREIT, which are close to 39%. And if we look at purely the office REIT, it's closer to 43%. So we have a very competitive positioning as well on the gearing, while the cost of debt is fully hedged, or almost fully hedged, with 97% of all banks' borrowings. If we go on the next slide, which is more on the portfolio itself, and let's go straight on the one after. On the portfolio valuation, as I was mentioning, a slight drop into the valuation. And if we look at it on the like-for-like comparison, the decrease of the valuation has dropped by 2.6%. So again, we all hope, and from what we can see on the ground here, is that the worst is behind us. with valuation that for end of June 2024, which remained pretty stable compared to December 2023. If we go on the next slide, that's a snapshot of the main tenants. We worked over the several years with the team on diversification of the income. Initially, we had, historical tenants such as Deutsche Rentenversicherung, Deutsche Telekom, and since then we've added all the others, and that enabled us to diversify the income and creating, a more stable and sustainable income for the future. And now, if you look at, on the right-hand side on the chart, we've got over 61% of the leases that will expire only in 2029 and beyond. So that's really, the target, and what we've been working on over the last 4 years is continuing this diversification of the income to enable a sustainable DPU for the unit holders. If we go on the next slide, it's more, how we achieve and work on this, sustainable dividend. We have, an active asset management to optimize the portfolio. So in downtown campus, we signed 3 new leases, enabling us to reach an occupancy rate of 36%. As a quick background, the Darmstadt property was vacated last year by Deutsche Telekom, and since then we've been working, on letting the property. It has taken time because, the market after COVID on the office side was pretty slow. But since then, we have some traction, and we are in additional talk with a potential tenant to continue, to add some occupancy into this property. So we hope to be able to come back to you with additional positive news within the next few weeks and months on this property. On Berlin, I just mentioned before, we are in advanced discussion to sign, leases with hospitality operators. So that's, a shift to reposition this pure office single-let tenant property into a multi-use property. So that's something that is on track, and we look forward to sharing with you some good news on that in the coming weeks. On Spanish portfolio that has been acquired in 2019, we have worked, on some improvement into the property. No major changes. We just had the opening of a data center in Sant Cugat Green, which will enable, to continue to attract new potential tenants into the property. While on the French portfolio, it's more, working on the environmental certification of the assets. So again, here, it's pretty detailed, but it's all these kind of active things done on a local basis on the assets, being on the ground, and TKO, has boots in all these countries. So that's enable us to actually be close to the asset, close to the tenant, and to ensure to anticipate, any potential concern. If we go on the next slide, looking ahead, what are the main priorities for IREIT? What we look at, on the macro side is that the office market in Europe on the letting and on the investment side have now stabilized and obviously remain, much below the 10-year average. So we see that, as being an opportunity, and we hope that the next, the worst is behind us. That's the way we see it, with interest rate cuts coming up, inflation going down. So there are still, things happening or news which can be negative, but it's related to the consequences of the last 2-3 years. but we already start to see some improvement with new transaction coming up on the market, which would not have been there, just 3-4 months ago. So that's pretty positive. On the retail side, the market has remained resilient. I think, the retail went through their worst period through COVID and even before. So the shift on the retail side happened before, and what happened on the retail side is in a way currently happening on the office side. So retail has remained resilient, and the footfall and turnover that we have on the property that we own are actually pretty good. So that's good. So we should benefit overall, of this kind of lower inflation, rising, wages, further interest cut. That's what we consider for the future. And if we look at, obviously on the portfolio, what does it mean for us? Obviously is, continuing to increase occupancy overall on the portfolio, as we did in Darmstadt. We continue our efforts, and the idea is also to continue the repositioning and proceed with the repositioning of the Berlin campus into a mixed-use property in 2025. So that's pretty it on my side. Many thanks for joining, and Billy, back to you, as there might be some question for the Q&A session.
Right.
Many thanks all.
Thank you for the presentation. I think that's brief and also very comprehensive enough. All right, we do have some questions actually. Let me just pick up some of those. I think the first one is probably related to the Berlin campus, especially on the repositioning on it. Could you share in terms of the impact of it, like how much rental is it going to be better in terms of revenue as compared to before, and how long the process? I mean, I know you're already in talks and all that. So will there be any impact in terms of your revenue during this period of time when you're having that discussions? Because, yeah.
Sure. So yes, Berlin is obviously, a major property into the portfolio. And what we are doing now is, ensuring that we are maximizing the value of the portfolio of the property for the unit holders, you see. So there's an income component on one side, but there's also, the value of the property itself, you see. And so we're working on maximizing the value of the property by having all this plan, of how repositioning it, putting tenant into it and all that. What does it mean? It does mean as well that in the short term, IREIT will no longer benefit from the income of this Berlin property on a regular basis. Repositioning should be around 12 to 18 months before we are able to get a tenant into the property. But on the other hand, we see, and management will see how we can mitigate, potential drop into the DPU by using some of the available proceeds we have, either from the sale that we had in Spain earlier this year, or through this lump sum amount that was paid by the tenant, you see. So that's the approach we have. What is important for us is to ensure we are maximizing the value of the property by having all this plan, all these lease contracts signed and all that, while at the same time mitigating the DPU drop by using some of the proceeds we received in the past.
Okay. Sorry, how long will this process take? Like for it to be sort of finalized and for Berlin campus to be repositioned in its new?
Yes, so I think it's it can be it will be there will be different phases. So in a way, you can start having tenants in some portion of the properties. So let's say it will be between 12 to 24 months.
Sorry, come again?
I would say between 12 and 24 months.
Okay. All right. And just wondering, I think there's a question on, I think previously during the COVID crisis, can you share some of the steps that have been taken, like to manage some of this, some of the lessons that you guys have learned from that period of time, and especially if your involvement in retail, right? So yeah.
So it just, yeah, I think, let's see if I get answer properly to this question. If not, let me know, and I'm happy, to answer differently. I think, you're right. Through COVID, we learned that, for instance, we retail was something. I mean, let's put it this way. Retail, we were convinced that retail was interesting to look at, and we considered that when COVID came, it was even more interesting to look at because a lot of people thought that COVID would kill retail, while it was not the case, and it enabled us to enter at very attractive pricing for the Decathlon portfolio, for instance. So that's the kind of approach we had, and just because retail went through repricing period over the last 6-7 years with all e-retail, so the entry price on the retail side became very interesting. Here on Berlin, for instance, what did we learn from COVID on the office side is that the demand is different now on the office side, and that's why we want to reposition this property, and we are allowed to do it from, let's say, a planning point of view, to repositioning as a mixed-use asset, you see, because
Yep.
that's the kind of future for this kind of properties, mixed use and multi-let, you see. So in other words, a building now, I mean, could be used in different ways with different type of tenants.
Okay. All right. I think there's another question since we talk about both retail and office. In the next 2 to 3 years horizon, what's the expectation in terms of the market trend for both retail and office in Germany, France, and Spain? I'm assuming it should be similar for the three countries, but if it's different, then you probably just want to just highlight which countries probably have more opportunities and stuff like that. Yeah.
Sure. So I think, I mean, let's say, I think, I mean, the trends will be positive. There has been a significant, repricing over the last 2 years, which, I mean, obviously relates to, slowdown, structural changes in terms of usage of the office space, interest rate, which was increased. But what we consider is that what we can see in Berlin, for instance, prime rents are still increasing. You see, the prime rents are just going up.
Okay.
And while the interest rates start to go down, and we have seen drop in valuation. So we consider that we will continue to have positive trend, and especially because there is also a demand behind that. If you have a good quality building, the vacancy is very low. If you look at in Berlin, vacancy for all across the city is below 5%. You see, so it's a very low. I know it might sound slightly higher than what you have in Singapore, but that's actually very low because in this vacancy rate you've got a lot of old stock. You see,
Okay.
so that's a very low, very low percentage.
Okay. All right. And since you mentioned interest rate, and there's also a question on that, how do you see the trend in Europe is for the interest rate? And is there any opportunities? I think this will probably be how you want to take advantage of your low gearing level to sort of grow your portfolio.
Yeah, it's exactly this. So it's just making sure you're looking at just at the right time, not too early, not too late, but just phase it at the right time. That's it. You see, that's, I think, the strategy for us has always to be, pretty cautious with leverage, up to looking at when it can make sense to use this kind of potential dry powder that we could have to actually go and invest onto the market, you see. So that should come, I guess, pretty soon. Yeah.
Okay. I think there's a question on the Berlin campus as well. I think, do you have any like assumption in terms of the percentage on the mixture of usage? I mean, it's a mixed use, right? And the
Sure.
tenancy. Yeah.
Sure. I mean, let's say, I mean, it would be around 30-40% of non-office use, and the rest will be office.
Okay. So that's the target that you're going for, I'm guessing, right?
Yeah. And I mean, if you look at, you've got very interesting transaction currently on the market here in Berlin. You've got a significant building, which is one of the, iconic building in Berlin for over 400 million euros, which is on the market, which does reflect, cap rates around 4.5%. And that's this kind of building, which are mixed use of office and hotel. So, I mean, that's what I'm saying, or that's why I was trying to explain before when I say, the market is picking up. This kind of transaction were not on the market 3-4 months ago, and now it's back, you see. So that's pretty encouraging.
Okay. I mean, I know your gearing level currently is quite low. Will that affect the loan for the redevelopment of the Berlin campus, will that affect your gearing level? Like, what's
Yes, so I think we're currently, renegotiating and looking at, for the financing. Obviously, the financing of the repositioning of Berlin, or the funding will be done with, with a mix, or with a use of debt, which would have an impact. But I mean, obviously, the idea is to remain in a healthy position, and the gearing that we're having now. I mean, we've got sufficient debt headroom to
Yeah.
remain in a safe area. Let's put it this way.
Okay. I think there's one more question on Darmstadt campus. What's the current total occupancy? I mean, and when do you target to complete filling out the spaces?
Hard to tell. I wish I could tell you 100% tomorrow. But it's okay. So maybe a few words on Darmstadt. Darmstadt, so currently occupancy rate 36%. Okay. We've been able to let 25% end of last year, or mid last year. Then we've added, 3 additional tenants. Darmstadt is not in the city center of Frankfurt. It's in the greater Frankfurt, so still, very active location, but not prime location, you see. So for this kind of asset, there has been, a slowdown in terms of demand. While I mean the location is, business park, it's actually, pretty active there. So we have seen that the interest from tenants have picked up. So we are currently in discussion with several tenants, potential tenants, to come into the property. So I think, I mean, what is the most difficult? Let's put it this way: what is the most difficult for this kind of building is to secure the first tenant. When you have a full empty building, is to get the first tenant. So we've been able to get this first tenant, which is a public body, which signed a lease contract for 15 years. They came for 25%, and then it enabled us to attract all the others, you see. And we can see that it creates additional traction. So, it's a kind of exponential trend, you see. So I know that, unit holders are frustrated, and I totally understand it myself. I mean, I wish I could, bring more additional positive news on Darmstadt. But unfortunately, that's the kind of, things you have on the real estate side. It sometimes takes a little bit of time, but we can see that the activity is growing on Darmstadt compared to what we had before. And I really hope to be able to come with additional positive news shortly to unit holders.
Okay, I think your slide you mentioned that there will be further initiatives to drive the occupancy to half of the property within the next 6 months, right?
Yeah, correct.
Okay, and I think it's a question whether you guys would also reposition Darmstadt campus just like what you did with Berlin campus. Is that something that's possible?
No, no. I mean, you know what? I think the Darmstadt is will remain an office building. It would cost much more to reposition, and I think, I mean, it might not be even logical given the location, you see. So much better to keep it as an office building. But what we do is we're moving from a single let building into a mixed-use asset, you see. Darmstadt building is actually, the one you've got just behind me on my virtual background, you see. So that's really, a kind of asset that we have, which it looks, very good. It's a property which is pretty recent. So we'll keep it like this, but just put it on a multi-let basis.
Okay. There's another question whether you guys have any other plans in terms of, aside from rejuvenating the campus, any other future purchases in line that you can share with?
So I think, I mean, we continue looking at the market. Obviously, logistics, I mean, we wanted to expand there. It's just, still pretty expensive. But we'll continue, looking at things. Obviously, I mean, through, the resource that we have on the ground through TKO. So on the office, on the retail, on the logistic, uh, the idea is, is to eventually look at, Benelux as well, Italy. So that's, this kind of territories as well that we would like to explore to continue diversification. not only from an asset class point of view, but also from a geographical point of view. But at this stage, nothing concrete to come to unit holders with, you see.
Okay. I just wondering, I mean, I know your interest rate exposure, I think 97% or something you will hedge, right? So just wondering how will if the interest rate environment affect you, whether if it were to remain high for longer or if there were to be interest rate cut or anything. Could you share some
Sure,
of
sure. So we've got, weighted average debt maturity of 2.2 years. So, I mean, if, things are moving up, we're not impacted or, marginally because only 3%, 2.9% is not hedged. Um, and, then afterwards, it's just a question of renegotiating and when, the hedging tools are, ending. So it's more at this time and at this juncture that you have to refinance and take a new hedge, you see. So that's the way it is.
Okay. And I just want to know, because I think you shared your occupancy rate earlier, which is around 89.8. I think it was a slight drop from previous was 90% or something. How
Yeah,
how
correct.
compared with the average in Europe market? Because we obviously probably, I mean, I'm not familiar with the Euro market, so probably you can just enlighten us, so we can know in terms of comparison how you guys are doing.
I mean, it's hard to tell about, comparison of specifically on the occupancy rate because it really depends on, what you have in your properties. But I think, I mean, if you look at, if at least, on your side, you can compare it to, office REIT in a way. Obviously, I mean, Singapore let's say it's a very specific environment. But, it's a kind of that does compete, with or does compare with other European REIT. And what is, uh, even more interesting is about, gearing, where, maybe European REITs may have, gearing which is higher than what we have, you see. So yeah, I would say it's pretty similar. Yeah, it's really hard to tell. It really depends on one case from another, you see.
Okay. But what about in terms of if let's say we're just looking at, say, office or retail, is that something that we can have a comparison? No.
Retail, I mean, we know we've got 100% of retail, which is fully occupied. So occupancy rate 100% on the retail side. If you look at, retail REITs, I mean, they're not 100%. They don't have 100% occupancy rate, or I mean, very specific cases, you see. So on our side, I mean, we are fully occupied. So the effort is much more, on the office side in Germany with Darmstadt and in Spain with Parc Cugat, Delta 4 and 6, and with San Cugat. So that's the key focus for us.
Okay. And I just wanted to ask you in terms of the Berlin campus, have there any lease agreements that have been finalized with tenants?
It's, in advanced stages, nothing's finalized yet, but we are, in exclusive discussion with two hotel operators for, 25% of the space.
Okay. And I think Amanda has another question about occupancy rate in Spain. Will increasing the occupancy rate in Spain help to elevate the occupancy downtime from your Berlin campus and Darmstadt?
Yeah, so that's, also something we're working on is, continuing to increase occupancy rate in Spain. But, having said that, the Spanish portfolio in terms of value or weight versus, Berlin is slightly lower, you see. So, I mean, just to give you an idea, but Berlin valuation is around 229 million euros, more or less. And here, the valuation of the four properties in Spain is 129, you see. So there's 100 million difference there, you see. So it's not exactly the same kind of weight, but still, you're absolutely right. I mean, continuing to work on increasing the occupancy rate to mitigate, the drop. And I think Darmstadt is exactly also what we're doing.
Okay. So there's another question on your percentage of retail to office properties within your portfolio. Do you have that?
Yeah, sure. It's on the first slide. We've got 24% of retail, and the rest is office.
So is that
And
So is there a plan to shift that target to something else that's more optimum that you think it would be?
I think, we with the idea here, continuing diversification out of office, and, mixed use by purely repositioning Berlin, we would do so. But it's definitely, acquiring more retail and more logistics to actually continue diversification. Yeah.
Okay. I think you said that the worst is probably over for especially for the offices in Europe. But just wondering, what are some of the strategies that you guys are doing that you can share with us that to sort of attract, to increase the occupancy across your properties to get people back, like because I think it's quite I'm not sure whether how the recovery is in Europe, but I'm sure that as if you look at the numbers that there are still some challenges around. So what are some of the initiatives that you guys do that differentiate, compared to other office buildings that are available? Yeah.
I think, what is important is to make sure you got, a building which answer to, or, which matches with the criteria of, potential occupiers, and that you are very local, you see. Being local is the most important, being on the ground. So it's the network that you're having which makes the difference, you see. And TKO, has boots on the ground in each individual country here, you see. So we can leverage on our sponsor to actually, being in touch, being with, the local agents who don't even speak English, you see. But I don't care, if the German guy he speaks to the German guy, Spanish guy, you see. So that's the way it is. So that's for me the most crucial thing, rather than, having big marketing plans or whatever, which obviously we have, you see, because it's all about marketing. But what is important is to be next to your potential tenants, next to the agent, close to your market, to ensure that, you fight to attract people into the property. If I look at Darmstadt, for instance, the tenants which are coming into our property, that's the biggest letting that is currently happening into this location, you see. So I think, that's how we fight.
Okay. And I think there's another question. You guys have currently retail and logistics split. Will we add hospitality to the mix?
The hospitality would come, for instance, through what we're doing in Berlin, you see. And that's, by putting 2 hotels into the property. So yes, in a way, that's something that the REIT will be exposed to in the future.
Okay. Just want to ask a bit more on the economic front. I think the euro has shown some weakening trend and stuff like that. Is there any plans to sort of mitigate the FX risk?
Uh, Not really. What we are doing is, we are distributing in euros. So there afterwards, it's more, unit holders and individuals who can decide what they want to do, as regard to mitigate any potential, currency risk if they want to see. But we are distributing in euros, and people can decide what they want to do.
Okay. I think you talk about your portfolio valuation just now, especially the repositioning of the Berlin campus. So just wondering, what are your views on the current portfolio valuation? I think there's a slight drop. It's probably not that much, but
2.6%.
yeah. So
Uh, yeah.
what was the driver for that, do you think? And how do you see that going forward for you guys? Like,
Okay. I think valuation, valuation has dropped much more, significantly over the last 2 years. The portfolio was worth, uh, 1 billion euros almost 2 years ago. You see, now we are 850. So, there's been a sale, but the sale is like minimal, is 24 million euros, you see. So I think, the impact or the shift on the valuation happened, already, you see. So that's why we consider that, if we look at the net initial yield currently on the portfolio, we've got a net initial yield of 6%, which is really reasonable, you see, and we're not like other REITs, which may have, still cap rates at 4.5%, you see. So I hope but I'm not, the valuer. But I'm convinced that, it's behind us.
Okay, that's good to know. I think there's one part that is for probably for those of us who invest in REITs, we're looking at dividend, right? So I know that the distribution per unit has increased slightly in the first half of this year. Can we
Yeah.
expect similar trend in upcoming quarters? I mean, there are some concerns on the repositioning on the Berlin campus, how it will affect your revenue and stuff during the meantime. But can we expect it to remain stable for your DPU at this level?
So I mean, I'm not supposed to to predict things. So, but I think thanks for asking the question. I think it's what I would say is, and that's what I said just before is the we know that there's that's obviously something which is important to maintain sustainable DPU. So management will uh, will mitigate uh, the uh, the potential drop or the drop of DPU of Berlin uh, by using potential uh, proceeds that we have secured. Having said that, Berlin is 24%, but what we of the income. But what you have to look at as well is all the potential growth coming up and value coming up through this repositioning of the property, you see. So I think it will be much easier we'll be able to say much more once we are able to provide slightly more information about potential tenants coming in and timeline for unit holders on this repositioning, you see. So, but definitely, that's a focus from the management to mitigate any potential drop of the DPU.
Okay. And just wanted to ask, I think, do you have the slide where you show the leases, the staggered leases?
Sure.
Let's take a- Yeah. I'm just wondering, they say that over 61% of the lease will only expire in 2029 and beyond. So all these are long-term leases, right? I'm guessing. Is there any
Yeah.
strategy for that to maintain, to maintain these long-term leases, especially when it comes 2029? So is there any other measures that you guys are doing to mitigate the risk of early lease termination if there is?
So what we are doing is anticipating. So just to give you an example, we are currently discussing with one tenant. So in 2024, their lease is not expiring before 2029, but we are currently discussing about already an extension, you see. So that's this kind of active asset management that I was referring before, you see, and ensuring that we can all the time anticipating things in advance to ensure that we provide visibility on the potential income.
Okay. I just want to ask one more questions on the sustainability portion, especially for investors who are interested in ESG stuff. Is there any sustainability initiatives that you guys are doing for your properties across that you can share?
Sure. So that's something which is very important to us. So we've got all our property which has been certified. So we've got BREEAM-In-EU certification or LEED certification, excluding the French portfolio that just has been acquired, so the latest one, the B&M, and that's why we are currently working on this portfolio so that they receive certification by December 2025. I think this is very important for us also because it's a way to maintain value of the properties, you see. And we are able to do that without doing major capex because the building that we have are pretty recent or in good shape, you see. So that's something very positive, is we are able to get certification easily on our properties. Berlin, obviously, it will come through the repositioning. And I mean, for people who are interested to look at that in greater details, I mean, we have a very detailed, sustainability report that is published on a yearly basis, where we go through, all our initiatives to make sure that we have a sustainable portfolio from an environmental point of view.
Okay, it's good to know. I think Amanda has another question. I think it's regarding the leases that are expiring in 2024. Do you have the percentage of how much that have already renewed their leases? Because it's already September now, right? So
Yeah. So I think, I mean, 2024, actually, the amount is mainly related to Deutsche Rettungsversicherung, you see. So that's, Berlin property, which
oh,
is actually, the major impact, or yeah, that's the main contributor in 2024.
okay. So that's the reason for the 24% now. All right.
Exactly.
Okay. Last question. Don't want to hold everyone else here. What are some of the key risks that you want investors to pay attention to that you think that you want us to look at, especially when looking into REITs with exposure in Western Europe? Yeah. What should we
I think, I
pay?
mean, you need to look at, but it's the quality of the portfolio in a way, ensuring that, you've got assets that are sustainable on the long term. I think as well, gearing is something important, because so far you don't have yet, I mean, some people, refinance their portfolio few years ago, but it's not already the end of the lease, the financing contract. So that's this kind of things to look at how it will impact the REIT afterwards in terms of income, because obviously swap rates have increased, so that's also something which is important. And last but not least is how the team are structured. I think for me, real estate is a local business. You need to have local teams, but it have to be structured in an efficient way, you see. But that's very important to ensure you've got, the right sponsors, and a strong alignment of interest between unit holders and the sponsor. I think, especially in this kind of period where you can't analyze everything yourself as as a unit holders, but at least what can keep you sleeping on your 2 ears is to ensure that the sponsor have also skin in the game, you see. I think that's what is the most important to me.
Okay, it's good to know. All right, I think there's no more further questions from here as well. So just gonna end the session. Thank you guys. Thank you, Louis, so much. Thank you. Appreciate it.
Thank you. Bye, take care.
Bye. Take care.